talk about something that every single founder wishes he came up with like the secret sauce for, which is managing money in startups. It's the big question. Funding rounds are exciting, burn rates keep us up at night, and runway is everyone's favorite buzzword. But what's the real secret to making all this work? To answer just that question, we've got an amazing razor-sharp finance mind with us today. Gaurav Jain, Senior Vice President and India Head, GIC. We're going to invite you on stage, please. Round of applause. Ramesh Bafna, CFO, Zepto. Rohin Vig, CFO, Acko. Please be careful. Everyone keeps falling on this. Thank you all so much for being here. It's super exciting. I can't wait to hear what's going to be happening with this wonderful chat. And to answer all these wonderful questions, we have, to find answers to all these wonderful questions, we have Razorpay's Chief Financial Officer, Arpit Chug, who's going to be doing this wonderful fireside chat. Thank you so much, Arpit. Great to have you here.
Good afternoon. Hope you guys had a good lunch, and hopefully we can help digest some of it in the next 30-35 minutes. Thank you, Gaurav, Ramesh, and Rohin for taking the time to join us today. Really looking forward to an enriching discussion. When first the topic came up of secret to managing money in startups, first question that comes to my mind is, what stage, what industry, what's the goal? So, things can vary significantly, I feel, on the scale and, stage of the company. So, with this diverse experience today, we'd love to go a bit deeper, unpack things, and get some insights. So, welcome to the panel, The Secret to Managing Money in Startups. Really excited to have, have all of you. And, before I go to the CFOs and get an operational lens, Gaurav, I want to start with you. As an investor, what do you look at, not in terms of necessarily identifying companies, right, because you're looking at business models and, TAMs and opportunities that you believe in, but from a financial metric perspective, from a financial capability of the organization perspective, what are the things you look at from an investor lens?
Hi everyone, good to see you all. Actually, the secret is not so secretive. It's about very prudent management of money, investing for the long term. And really the way we think of financial strategy is if we can marry with corporate vision. And then corporate vision married to corporate allocations of resources, and then you have a good financial strategy in place. I broadly break it down into two parts. The first part is cash flow management. As a startup or even as a late stage company, it's important to think of cash flow management from various aspects, especially if you're burning money in the early days. It's about how much can you burn, what kind of runway do you have, and then marrying it to what the business outcomes need to achieve. Liability side is an important side of the balance sheet that is often ignored. I think a lot of companies and builders are thinking about the asset side, the revenue side. But the moment you start thinking of how do you fund the capital that you need, and need not always be equity, it could be debt, it could be venture debt, etc. That really helps you augment and think of capital structure in a more meaningful way. The second aspect is capital allocation. Capital allocation need not be democratic. Not every business line needs to get the same amount of capital. Not every business line needs to get the same amount of people. It's really about how do you think of the long-term value of each business and then allocating capital within those lines. So if you talk of metrics, I think we think of really two metrics. The first is lifetime value of a customer. For every customer that you get on board, what is the lifetime value that you can achieve, and then dedicating the right set of resources behind it. Software companies are actually a great example. They exhibit high gross margins, they exhibit high retention rates, and the question is how much can you invest in acquiring that customer, because you know that once you acquire that customer can be with you for a long time, which is why you see a lot of SaaS businesses burn a lot of money in the early days because they know the moment they get that customer on is really going to survive for a long time. The other is even consumer businesses. If you have a fairly sticky customer base and you can cross-sell that customer over a period of time, then it actually makes a lot of sense to go and acquire that customer and then get them on board and then keep cross-selling multiple products to them.
No, thank you for sharing that. I think the big takeaway, for me on the balance sheet, right? I think so much of the world is just focused on, revenue and EBITDA or the loss at an EBITDA level that I think people often forget about, the balance sheet side of things. So, thank you for calling that out. Very, very insightful. I want to have a small follow-up question on the SaaS model that you talked about, Gaurav, that yes, there is early investment required because there is a tremendous lifetime value. But at what point you as an investor start to get worried that, the balance is not emerging?
No, I think that's a great question. Honestly, again, it's a function of how much capital you have. But if you look at payback periods or lifetime value and then can justify the amount of money you're spending for that customer, then the math starts to make sense.
Understood. No, thank you. Moving on to my CFO friends here, and before we go into details around startups and financials and managing money, I think all three of us have something in common. As expected, we started our careers in large companies, right? Because maybe 10 years ago, there weren't too many startups of scale in the country. The transition to Razorpay from American Express was certainly interesting for me. Rohin, I want to start with you. You obviously worked for a long time at companies like Bharti Airtel, and then very young startups, Myntra, Oyo, now Acko. What's been your experience? How was the transition?
Frankly speaking, Airtel when I joined was more startup-like, actually more startup-like than Myntra and Acko specifically Acko that I've joined. We were growing at a breakneck speed. Even we did not know how much we would actually grow. Had we known, I'd probably have retired by now. Because when I joined Bharti Airtel, it was 22 rupees a piece, and it's 1800 wherever it is. But having said that, I think what distinguishes and the change that we come across is fluidity of the business model. Specifically, let's say you take Myntra as an example. Myntra tries to evolve itself. While it started as, if I'm not wrong, as a printing and stationery brand, it evolved into fashion and then fashion into fast fashion. Today, it's doing forward fashion, which is extremely, extremely difficult. So it keeps evolving, and every startup has this fluidity. And that is what you need to, I would say, pivot yourself to as you come from a large company where you know the next 3 years are set. Here, the next 1 year is kind of fluid, and you have to manage that ambiguity very, very well.
Oh, thank you. Thanks for sharing that. Ramesh, same question to you. You spent time with Cisco, Wipro in the early part of your career, and then of course you've been at Flipkart, Myntra, now Zepto. Love to hear your thoughts.
Thanks for having me here. It's fantastic event. From my side, right, this is the first year I have spent more time in startups than a legacy company, right? I spent 10 years with Wipro, and all startups combined, it's 11th year for me. So to that extent, it's more startup than the legacy companies. What it teaches us, right, in terms of Wipro, it teaches the fundamentals, the depth and the experience. SAP system, from a finance perspective, it grounds you in terms of the fundamentals. But when I joined Flipkart and then over the years right now with Zepto, it's a lot of thing is about mindset shifts. Right? When I'm in a legacy company, it's about optimization and bringing in efficiency of the process which is already set in, to a startup where I come in, work with the founders very closely, figure out along with them in terms of the business models, or build an opportunity to build a lot of revenue structures or cost optimization processes grounds up, right? So to that extent, the satisfaction level, the empowerment, those elements are significantly higher, because if you're a builder mindset, then you kind of be proud about what you have done over the years in terms of marketplace model at Flipkart, or CFO as Myntra, or now at Zepto in terms of how we are running. The second thing is love for speed. So you basically, Zepto, I would say, is like you are high speed in a slow-mo, right? So it's a breakneck speed in terms of execution, in terms of the kind of the growth we are seeing. However, as a finance person, right, I need to ensure the systems are also just not functionally, but also business oriented to support that kind of growth, right? So we grew 3x in last 8 months, and without the right processes or having the payments on time or the hygiene in place, it's going to break very, very fast, very soon, right? And on one side, you manage those things. On the other side, you figure out more business models, what additionally I can add to that business structure. For example, we started grocery, then we added fashion, we added more categories, or the different business model like Zepto and Zepto Super Saver, where we add more baskets. So you're working along with the business stakeholders on an agile basis, which doesn't happen in a legacy system. So it's a fantastic place to that extent. And building your own team, building your own culture around how the professionals across, in last 20 years, if you look at Zepto team, which I built it from the people who have worked in last 20 years and also from campus. So it's a good combination of campus and the leaders across the industry. They're coming together to bring that accelerated learning in a very short span of time at Zepto.
No, great. Thank you. Thank you for sharing that, and fully resonate with what you've said. If I share my experiences of coming from a very large company.
Don't mind the banter, but how do work hours typically transfer from a large company to a startup?
It's a trick question for sure. See, work hour and those things all about how do you manage your life, right? And what is important for you at that point in time. So it's not for everyone, not for faint-hearted for sure, but people who are up for it, who really want to build something and create meaningful for themselves and in the business side, it's the best place to be.
Yeah, Gaurav, let me also answer that. I think beyond work hours, I think one of the biggest differences for me has been the number of decisions that one ends up taking in a day compared to the number of decisions you end up taking in a more larger setup, and that has its joy and challenges, right? And that's what makes it quite interesting, and therefore, to Ramesh's point, it's not for everyone.
Just to add, I think what Ramesh also said, it's about empowerment. So the moment you join a startup, you're much more empowered than a legacy company, and that actually is a thrill. That actually is also a pitfall. So you are up for that thrilling ride of making decisions, getting it wrong sometimes, but hopefully making it right. That's where in it for. And ours, I think, is a byproduct.
Yeah. No, thanks. Now that we know what it feels like to manage these companies as from a finance perspective, let me get into some specific aspects, right? I think as startups mature, right, their size scale dramatically changes from what it was, let's say, a year ago or a year and a half ago. Objectives change. There are investors involved who have certain expectations. So this is a question to begin with to both of you, Ramesh and Rohin. Ramesh, we can start with you. On how does the financial strategy change as the business matures? Or if you could share some examples from your experience.
Yeah, it's a great question. It's basically in terms of early stage, it's all about figuring out and achieving the product market fit, right? So at that stage, you're not really looking at optimization or even financials. What you're really looking at is your product resonating with customers. You're going into an acquisition spree. You're figuring out whether the tweaks, the engineering bandwidth. I think that's the right kind of allocation to be done in the initial stages, right? And as you figure out, yeah, you have achieved a real product market fit, and that's when you really get into the processes, unit economics, what's going to work, and then put out a charter around it. So then unit economics, cash flow management, like Gaurav said, right? The first, at least in Zepto, what I do is I have a weekly cash flow review, even if there's P&L review or not, but cash flow review definitely happens, right? In terms of a health of balance sheet. So to that extent, then you kind of shift gears and you have to manage the investment cycles well. Ultimately, the role of an investor is to put capital, and the role of CFO is to ensure capital allocation between each business units how they're synchronized to each other are actually returning that value back to the shareholders, right? And the way I've seen is we have gone deeper and not looking at accounting-based P&Ls anymore. All my P&Ls today are customer backwards, right? In terms of the life cycle of the customer, first-time buyers, early life cycle, or a mature customers, how they are panning out, if I'm investing in which segment. So as long as I know my investment thesis is right in a particular area, and then I continue saying that as I grow, is there an operating leverage? I am like a kind of getting and harvesting it over a period of time, right? So in terms of investment cycles, a controlled aggression in terms of going it very fast, but also ensuring that we build the right products. For example, brand monetization tool, multiple tools which given that kind of leverage back to the system over a period of time. So when the maturity of customers happen, there is a profitability which comes over a period of time. So from a profitability versus growth, there's typical question is or, right? For me, it's growth and profitability, because profitability is not going to come without growth. Right? So that growth itself is the biggest lever of profitability from a leverage perspective. And that kind of opens up a lot more avenues for you to negotiate, to innovate, and add that much more product and tech bandwidth in terms of creating the right unit economics. So that's from the late stage, and then you kind of prepare for IPO. So you put in a lot more governance layer around it, have the right committees in place. So that's the entire spectrum of things.
Got it. No, I think a lot of very interesting insights, but I think the one that was very powerful is not the accounting P&L, but cohorts, right? That the customers you acquired at in a certain structure, in a certain city, or in a certain time frame, how are they behaving, right? Because need that insights to drive the right decisions.
But one more thing which has changed significantly, right? And even in last 10 years as startups, the startups have also meaningfully from speed to excellence, right? And how does a CFO move from speed to excellence? The gap is the automation which we have done, right? So I have worked very closely with the product and tech and engineering team. We have a specific bandwidth only for finance. So all the dashboards today are live. Earlier we used to talk about CD5 closure of books, then we went weekly, then daily dashboards. Now the way the kind of work we do is extremely operating excellence work. Anything which is not tracked live in terms of top line, profitability, cost structure, it's going to head for a disaster, right? So as much as possible, automate every single metric which is important for your company, and then the magic happens, right, at a real-time basis.
No, that's a great point. At the scale and complexity at which large startups are operating, I think getting information at the end of the month is not ideal. Rohin, your thoughts?
So I'll just add to 2-3 points. At Acko, what we have is a linear structure for customer acquisition. So we started with auto, we are into health, and we believe that the same customer is who will buy life from us. At the same time, the money that we invested to create our auto brand will maybe a 50% of that will be spent for creating a health, and 50% of that will be for life. So hence, anyways, the demand for capital keeps decreasing as you grow and your brand is well established. If you have this linear vision that, hey, I'm only going after this set of customers, the top 20 cities, that's where Acko is. But at the same time, you also pivot, or you also have certain other angles of acquiring a customer. As an example, we got into Acko garages. So we have our own garage now in Bangalore and one in Hyderabad, and we are going to expand that. Specifically, it came from a need because Acko is not physically present, and for a physical presence, you just don't want to open a branch and become, for lack of a better word, any other general insurance company. So, but a garage gives us a physical presence. It also gives us a customer acquisition engine. But the financial lens that we'll apply for it, we are not burning money on our garages. We're not putting capex, we're getting partners. The OPEX is so well controlled that even with the small revenue that we earn, from non-Acko customers are able to fund it. So all these pivots, while will work in a long term, and perhaps in a wild vision of a promoter, it may turn into a separate company in itself. But keeping that aside, keeping reality in check, that don't burn money on the side projects, on the pivots that we're trying to be, because your main capital is for the main product, for the main customers. As Ramesh said, it's about that customer profitability of getting it right.
Got it. And Rohin, sticking with the Acko and kind of, I see that initially it was, health and motor, right? And I think that subsequently travel was also added, and I think I'm expecting more new BUs could be added. How do you think about investment in a new BU versus existing, and how do you allocate capital,
Yeah, so that's what Arpit. So for example, we added retail travel. We haven't spent any money on it.
Okay.
It's just being sold to the current existing customers. They come on board. They actually buy a travel policy. It's a year product. We don't do any marketing, even performance marketing we don't do, and it's a self-profitable business on its own. We want to do a domestic plan. So all these small items are incremental. We don't really want to allocate a lot of capital because the brand is there, the customer is there, the app is there, the processes are there. Maybe something like we're going to evolve into what I've also called as an Acko Drive, in which you can come and book a car and ultimately buy a car. I think Zepto is also selling Skoda in 10 minutes, but we're not selling 10 minutes for sure. So then when you're pivoting to that kind of a strategy, because finally what we want to do is acquire an insurance customer while he's trying to buy a car. That's where you have to be very, very prudent in allocating capital. That may need capital in the beginning. So you find capital from your existing profitable business and allot it. If it is becoming very large, maybe find a new investor.
Sure.
Pivot it into something new, maybe spin it off into something, a very different company, and create it. So that's where we look at it. Is it incremental business? Then let's not burn money. If it is really a large business, then maybe get new investors on board.
Got it. So the newer businesses are often cross sells with low burn and low capex, more greater monetization of existing customers. Excellent, excellent. Gaurav, Ramesh alluded to growth versus profitability. Last year at FTX, my entire panel discussion was on growth versus profitability, but didn't have an investor. So in that panel. So now that you're here, would love to kind of get your thoughts on, from your point of view, how do you view growth versus profitability? When do you think is the right time for a business to start thinking about profitability? Not at the cost of growth, but maybe stop growth at the cost of profitability. So would love to kind of get your perspective on that topic.
Yeah. So when we invest in companies, we always take a step back, right? And we think of what this business can become rather than what it is. If you think of every business, they would be largely structured on a few mega trends. Those trends could be India's growing payment volume. It could be changing consumer behavior in terms of how they buy groceries. It could be India's underpenetration in insurance. It could be AI. How do you structure your business in line with some of these mega trends? And when you're in the day-to-day or the tactical aspects of running a business, it's easy to really like lose the or miss the forest for the trees. The way we think of businesses and encourage our CFOs to think about it is really long-range planning. Think of a business that could be built 3 years out, 5 years out, and then revisit that plan every year, break it down into more manageable blocks, could be a quarter, could be a year, and then identify those trends on which you want to build the business on. The other aspect that allows you, that behavior allows you is really about what you don't want to do, what doesn't align to those mega trends, where do you close doors, which business lines do you not go after. And that, I think, is an important way to think about it. I'll probably borrow Ramesh's words that it's actually not a conundrum, it's profitable growth. But the moment you think of a 5-year view and where you want to build business towards, then those answers start unraveling for themselves and you can start aligning the business towards it.
Got it. You brought up an interesting topic, long-range plan. I want to ask both of you, given how dramatically the business changes in 12 months, do you put together a long-range plan? Every year, how frequently do you update it? Is it more a vision, or is it like a regular exercise that you do, going deep into developing that?
Yeah, see, overall, from a business model perspective, right, if you look at, I've been 18 months in Zepto and I have seen 3 Zepto, right? Every 6 months, there's something new which is significantly larger, right? We have added 2-3 more Zeptos in last 18 months. From an overall business model, how the scalability will happen at, let's say, 5 years down the line, we definitely have that piece in terms of how all these elements, business businesses which are kind of started or their mature stage, how they all come together and synchronize from that perspective. So that's from an Uber lens. But on an execution perspective, today we operate on a quarterly plans.
Okay.
Because it's extremely disruptive, extremely fast-growing, fast-paced company. So I want to be in a situation where I'm agile to what is the opportunity which is existing in this month. And for me, quarter is a long time. And then quarter backwards to month and month to a real-time basis in terms of how I'm operating and making those changes.
Got it. Right.
Yeah, so we have a long-range plan, and fortunately, I'm in a very boring industry, so it's it's okay. But yeah, 5 years hence is more crystal balling gazing. There are a lot of tailwinds and headwinds that you can't really forecast or predict, and hence you have to be focused on short-term and long-term equally. As an example, we don't know when 100% FDI will be approved in insurance. We don't know when the license mergers will happen. So all those will dramatically impact our capital requirements, dramatically probably impact our growth patterns also. But we don't know. We can't really plan for that. So you need to have a balance of both, as Ramesh said. But yeah, certainly, since my industry is a bit boring, it's yearly and not quarterly.
I'll just add that the scenario planning starts to become very important, right? Because you can't anticipate how the next 6-12 months are going to look like, but you can at least expect a few ranges of outcomes and then figure out the choice that you want to go towards. The other is to have enough dry powder to take advantage of dislocations in the market where you can go and either invest more capital or hire more people, because the competitive landscape around you is changing pretty rapidly as well.
Right. Okay, we have about less than 10 minutes left, and there was one topic that I definitely wanted to cover, which was the topic of IPOs. Since we have a lot of experience on the stage and want to hear thoughts. Gaurav, I want to actually start with you. You know, what changes do you expect a company to make as it gears towards, gears towards an IPO? What do you expect in particular CFOs to do? And then I want to follow that up to Ramesh to answer what he's actually doing as Zepto gears up for an IPO.
Yeah, I think the secret sauce is again that profitable growth. Public market investors in general have a shorter span of, I'd say, bandwidth. They're all looking at 40, 50 stocks. And unlike private companies, they have the ability to get in and out of a stock at any point of time. So what they're really looking for is a high degree of certainty, high degree of predictability. And each business would have certain parts of it that can be long-term profit compounders. Those businesses, there needs to be a lot of clarity typically provided by the CEO, CFO, that can operate in a very narrow band of performance, and you'll consistently deliver that quarter on quarter. You'll keep playing to the thesis. And then you could have a certain set of businesses that are growth investments or investment areas, which need to operate in a certain guardrail, that you'll not cross a certain burn level on these businesses, you'll not dip into profitability or a long-term ROCE profile that you'd want to work towards. And I think the moment a public market investor has clarity on what is a profit compounding machine, what is a growth area, I think there's a lot more predictability around how they start looking at the business. Public market investors look at a movie, right? They're looking at the stock every single day. They're not looking at a snapshot like a lot of private investors are looking at. The other thing, I think the persona of a CFO starts to change the moment they become a little bit more public, largely in the sense that they become the face of the company for many, many factions of society, everyone who's invested. So you'll have to start marrying the business acumen even closer to all the numbers that anyway a CFO is expected and be very familiar with.
No, very, very insightful. Ramesh, your thoughts, and Rohin, then your thoughts as well. I don't know when are Acko's IPO plans, but what are some of the changes that you've started to make as well? Would love to hear about that as well. But Ramesh, let's start with you.
Rightly said, Gaurav, in terms of business acumen, right? And that's the advantage of being in a startup where the finance person is in depth and equally entrepreneurial in terms of understanding and building the narrative. So I think it starts with the right narrative in the public market where they get it in terms of what's my business model looking like and where the investment cycles are and where's the profit harvesting going to be. So one is setting the narrative and then literally working backward from a company's profile. It's basically, ultimately it's about consistency in FCFF, right? Ultimately, it's about how do I hit those narrative or the milestones which I put out in the public markets consistently, right? And to that extent, then you kind of work backwards. And it's not a last 6 month journey, but it is about how you build your finance function, how you build a mindset, even while you're in a startup space, in a growth space, but you kind of build your process systems and governance around those pieces. If it's fairly automated, real time, right? For example, our GMV to cash is real time analytics, right? So that gives you a lot more comfort in terms of our reporting standards, in terms of governance standards, and then really looking at, okay, if this is the IPO requirement, having the right team with the right technical depth and experience. That's how I begin with. Have the right IR team, the right legal team on the transactions who have built the right experience, or the tax team, and then find the right partners to work with, have a deep learning sessions with them, and look at, for example, we just concluded a Singapore to India domicile change, because that was prerequisite for an IPO here. So, and that thinking started a long time back, right? We're just 2.5, 3 years old company, but the thinking has to start a long time back, and the preparation along with that, working backwards. So re-domicile has happened. Then you kind of look at your business model structures. What's the public analyst or the public market analyst is going to understand this deeply? What are your benchmark competition looking like in the public markets, right? That's the secondary piece. The third thing is in terms of the governance layer, having the right committees set up, audit committee, like all the committees put in place. So a lot of heavy lifting from a finance angle. It's one of the best times in terms of going deep into technical expertise. The way I operate is put the Gantt chart of all the things I have to do from here to the ringing of the bell, right? So as I mentioned you before off stage, right? We have like 180 things to do to get this over, and every item has its own life cycle and touches so many people across the company in terms of product, tech, business, and compliances, outside stakeholders. So to really have that in-house muscle, to build that kind of understanding of what all needs to happen, understanding of SEBI, understanding of regulatory scenarios, and then putting out the comprehensive list of things to do, and then managing that life cycle effectively. So that's kind of the work we are at the moment.
No, that's a very, very detailed answer, and it seems like there is a very detailed plan in place for you to go public. So, best wishes for that. Rohin, your thoughts?
I'll just take off from where Ramesh left. So to quote one of the CFOs of our investors, IPO is more like a wedding and post-IPO is more like a marriage. I don't know which one is more difficult. But having said that, it's about getting the culture right, getting your forecast right. There are certain things about compliances that you have to now get it right. You're no longer about private money, you're about public money, you're about more fiduciary responsibilities. And that's where the culture has to be built in, where they're getting the right team, right consultant, right deep dive into areas of improvement. What Ramesh said, getting that project right as to going live. There will be certain cholbes nas, to quote a Bengali guy, forecast miss ho gaya, cholbe na. Now it cannot happen. So things have to change.
But let me deep dive on that, right? I mean, given that startup businesses are evolving, right? I mean, this is the traditional expectation of you need to have a good earnings forecast for every quarter. How easy or difficult it is, for us as a group? I don't have an answer. I'm raising the question. And Gaurav, do you think there is a pass as a public company for lack of ability to forecast as well as some of the large traditional companies?
Look, I think a lot of public market investors are long-term and patient, but I think missing the guidance is looked down upon. Okay. So therefore, that high degree of predictability is kind of a prerequisite when you go public. But have to hear.
Yeah. Rohin, sorry we interrupted you.
Yeah. It's right. I think getting forecast right is not that difficult. It's just that sometimes you have to harness your own ambitions. You have to put more prudence and practicality to what is really in the ground, and perhaps not take very, very dicey calls. Once you've grown, once you have demonstrated to the market specifically that you deliver on your promises, maybe a longer period of say 4 to 8 quarters, and after that a little bit of unpredictability may, the market may forgive you. I mean, we can look at Swiggy as of now, what it is doing, the unpredictability to them. So for sure, it's a mixed bag, but when you are going into IPO and perhaps 12 months thereon, this is a critical aspect, and you have to get it right. Just be a bit more patient, and just over-deliver and under-promise, or vice versa as the case.
No, very, very helpful. I know we've almost run out of time. Extremely insightful session for me, whether it was thinking about balance sheet and cash flow, whether it's thinking about how to deliver your forecast through some good planning, or whether the insight of it's not growth versus profitability, but growth and profitability. Thank you so much for taking the time. I hope everybody enjoyed the session. Thanks again.